When investors talk about passive income, they often compare dividend ETFs and covered call ETFs as if one is simply better than the other. But these strategies are designed to solve different problems. In this video, we'll compare how income from both approaches evolved over time using official fund distribution data, while keeping one thing constant: the original purchase price. That allows us to compare each investment using yield on cost, showing how much annual income the original investment would be generating years later. Let's start with traditional dividend-focused ETFs. SCHD stands out immediately. Starting with a yield on cost of just over 3% in 2016, it steadily increased to more than 8% by 2025, producing the strongest long-term income growth in this comparison. DGRO also delivered impressive growth, although at a slower pace, while VYM provided a more balanced profile with moderate growth and relatively stable distributions. SPYD began with one of the highest starting yields, but its income growth was much less consistent over the decade. By 2025, SCHD had overtaken it despite starting from a much lower yield on cost. VIG and NOBL offered the lowest starting income, but both demonstrated the steady dividend growth that many long-term investors look for. The common theme is that these funds generally rewarded patience. Their income didn't grow overnight, but over time, the compounding effect became increasingly noticeable. Covered call ETFs tell a very different story. Instead of relying primarily on dividend growth, these funds generate additional income by selling call options. That means distributions can change much more with market conditions. JEPI provides a great example. During the highly volatile market of 2022, its annual income surged dramatically as option premiums increased, before settling back toward more typical levels. QYLD started with the highest yield on cost in this comparison, but its distributions gradually declined over the following years. DIVO followed a much steadier path before a large year-end special distribution caused a sharp increase in 2025. Neither approach is automatically better. Dividend growth ETFs have historically emphasized steadily growing income over long periods, while covered call ETFs have focused on generating higher income today, with distributions that can vary as market conditions change. Understanding those differences can help investors choose the strategy that best matches their own income goals, risk tolerance, and investment horizon.